Today's topic, 20% down payments, good or bad. The beauty of having an active financial planning practice, but also this fantastic YouTube channel, but also have a podcast, we get a lot of questions. And with a lot of this content, as I've noted in some of these videos in the past, whenever we start to see questions over and over again, we think timely video idea. So today I want to get into the idea of down payments on mortgages. And the big idea behind this video is I'm recording this video in late January of 25. I think that's always important to add context to, although this video will be evergreen just based on rates, right? But there was a period of time where rates were very high compared to what we saw just a few years ago. We thought rates were ticking down, and now rates have gone back up and kind of hung out there for a while. So we're back at this point where are rates ever going to go down? And we know they will. Everything is cyclical. We'll have them up, we'll have them down. It's just part of life. But today I want to cover the good, the bad, and the ugly for 20% or more. I'm going to add some notes too on physician mortgages. I know that as our main group, that will not be the primary focus of today's video. I will give it a note at the very start of the video here once we get into it, but it's more or less around your traditional mortgage. But I will say, even with rates where they are today, physician mortgage rates are also higher. So this is very prevalent to that topic as well. So stay tuned, all coming up next. All right, quick plug. As you know now, if you have not subscribed to the channel, please do so. Also, if you click on the bell icon, you'll get a notification every time we release a new video. Give us a thumbs up, share this message. Besides that, let's get into the video. So 20% down payment, good or bad? Here is my list of more. So possibly greater than 20%. Now, I do think 20% is a sweet spot. Now, if you're thinking, Chad, why is 20% this number that everyone talks about? Well, 20% is the number that helps you avoid something called PMI, or private mortgage insurance, which adds a little extra premium to your mortgage payment. Usually this goes into your escrow account. You get that bill once per year. You pay that PMI through there. Also property taxes, homeowners insurance, things of that nature. So that's why 20% is this magical number. Now, coming back to my physician group, my practice is all for the physician community. We also know that we get a lot of other high income professionals that tune into this channel. But for the physician mortgage group, you don't have to worry about PMI. That is really the main draw, one of the biggest draws of physician mortgage loans or doctor loans. Kind of go by a few different names, but physician mortgage loans are most common. So that might not be as relevant, but I will say this: when rates are higher, as they are now, still historically somewhat low, it may make sense for you as well, even though you don't have to worry about PMI, to make a larger down payment. That's all I'm going to add into this for the physician mortgages. We have great videos on that. Our blog also has great videos. Actually, probably one of the most popular topics we talk about. That 457Bs and backdoor Roths are probably the main topics that we get a lot of love for. So first up, who should be paying more? Possibly putting more down. I shouldn't say paying more. Remember, this is just an investment into your home. If the interest rate is higher. Now I know what you're waiting for. Well, duh, Chad, what's a higher rate? So for me, I usually call this around 7-8%. Why is that number important to me? I think if you were to look at your other opportunity cost, usually it's stock market, right? Historically, long-term full market cycles, over 10 years, should you outpace a 7 or 8%? Ideally, you do, or at least you're kind of keeping pace with it. So in my world, which I think there's plenty of other professionals that are much smarter than me that will also kind of use that range. That's the number where I start to think to myself, is there other places to maybe deploy some of that capital? So the higher the interest rate, the more relevant over 20% should become. Now, again, this is for people that have built up 20%. Right? That's also not an easy goal. In defense of my millennials out there, shout out. I know that that's not as simple, and especially where housing prices have gone. So I always put that caveat in there. But 20% is that magic number just in terms of getting rid of PMI. And then if rates are higher than 7-8%, I would start thinking about trying to get more than 20% down if you can, right? Who else should think about this? Well, if you're risk averse, right? If you don't like the idea of having this liability on your books and you want to put more equity into the home right away, this is your best way to do it. Put a larger down payment. And another way to think about risk averse is it's still a pretty hot housing market. Now, it depends on where you are in the country. As I joke with my wife, we likely overpaid for our current house in Tampa, Florida, but we still got a good interest rate. So we lost on one, but won on the other. We'll kind of see how it all plays out in the long run. But that was a good example of being risk averse in terms of we still wanted to get that lower rate. Home cost is a little bit higher now. So we were a little bit harder pressed to get a larger down payment. because of that higher home cost. And I think most of us are feeling that today. Again, it kind of depends on where you're at, but most of our clients are in those accumulator years where, buying homes, starting families, accumulator years from a work perspective. So risk averse says put more money down because you're going to add more equity to the home. So just in case that housing market starts to kind of take some of that froth off the top and prices come down, if you do have to sell your home, you're not having to pay money in. That's what I mean by risk averse. Third I put on here was really age and also just sick of debt. This is one of those personal conversations we have with clients quite a bit. Even if you have a low rate, yes, are you likely going to do better maybe investing that money over the long term? You should, right? You should. But if you are also just really adamant on not having debt or paying it down sooner, that could be another reason why you should be putting a larger down payment. The further you get down the line in terms of age, right? You don't want to be like on the verge of retirement, locking in that brand new 30-year, not super attractive for many. So that is one where that group, usually a higher age group or someone that's maybe very, I say risk averse, but I already use that term, but they're not big fans of having that debt around. They may want to put a larger down payment on there too. And then the last one I threw on here was just peace of mind, right? You put a larger down payment on there, you own more of that home, right? The bank owns less of it. So peace of mind. So that's the group where I think more than 20% could make a lot of sense. Now you could also flip that, right? Should anyone be doing less than 20%? 20% is a good goal for a lot of you. I know it's not achievable for everybody, but that is one where we're usually trying to at least kick out that PMI. Not that PMI is the end of the world. Once you eventually get up to 20%, you can have that drop off if you do some improvements to the home. The value of the home goes up. You can even ask for a sooner appraisal to try to get that off sooner. Usually still costs a couple $100, but if PMI is $100, $200 per month, usually make up that cost pretty quickly. Downsides, right? You're sitting there, you're thinking, well, I got a lot of cash on hand. I could put a big down payment down. We can do this. Let's cover 40% of this bad boy. All right, well, let's talk about it. Downsides. One, less liquidity. You're going to take that big pot of money, you're going to put it into your home. Now, if you read some finance books, you might say, but Chad, I can always take out a home equity loan. And you can. And that might be a good use of time. Keep in mind, sometimes those rates are pretty high. Right now, those rates are pretty darn high on home equity loans, home equity lines of credits. Remember, there is a difference. Home equity loan is more of your traditional fixed-based, hey, I'm going to take out 100 grand, I'm going to pay back over 10 years. Home equity line of credit, more or less a giant credit card. Not a good credit card. Now, it's a little bit lower rate because it's backed by the collateral of your home, but also, bad news, it's backed by the collateral of your home. So if you don't pay that back, could be a little bit of trouble there. So keep that in mind, but you can still get access to it. But in terms of low cost, or I should say no cost liquidity, we put that in the home now, right? It's not, we can't just kind of put an ATM on the side of the home and pull that cash out. You would have to do that in a formal agreement in terms of home equity loan, home equity line of credit. So less liquidity. Number two is probably my biggest one. And this is what I noted at the start of the video, right? Missed opportunities. You have, let's just call it $100,000 extra dollars. You can either put this as a down payment on your home, which would be over 20%, or you can put it in the stock market. Well, in the equity of the home, let's just say for simplicity that's going to keep pace with inflation. Call it 3-4%, just throwing random numbers out there. Well, in the stock market, again, over a long period of time, 10 years plus, should you do better than that? You should. Hopefully you double that. So that would be the missed opportunity is you miss out on a good market rally. And I say market rally, I'm not saying just this crazy jump up in a short period of time, a good consistent bull run in the market, just good diversified investing. You could miss out on that. And we're going to cover some ideas for this too, so stay tuned. But that would be your big one there, that missed opportunity. And I'm using it in investing. There could be other things, right? You missed an opportunity to do your own startup business. You missed an opportunity for the stock market. You missed an opportunity for a trip of a lifetime. I'm going to let that stay. I like that. I'm going to keep that one there. You get what I'm saying here, missed opportunities. Last but not least, I threw this one on here, lower tax deduction on mortgage interest. Now, the reason why I debated not adding this was because you should never add debt for the tax benefits. It's a side benefit. It's nice to have that deduction. But remember, even with a mortgage interest deduction, one, we're limited on how much we get of that, right? If you're going out and buying $3 million homes, remember the bulk of that is not going to get that mortgage interest deduction. Also, you need to itemize. So if you're sitting there and you're like, I take the standard deduction every single year, you're not going to benefit too much from that. So keep that in mind. But that is one other downside that you'd miss out there with that larger down payment. All right, last but not least, let's brainstorm some ideas here. So you're sitting there thinking, could put this money here. I could put this money here. Here's some ideas. All right, so if you wanted to pay down the home sooner, but keep that money in your pocket, I like the idea of paying extra on the mortgage. Now make sure it goes to principal only, but paying extra mortgage payments can also get that mortgage paid off sooner, right? That should not catch you by surprise. Again, make sure it is applied to principal only. But if your payment's supposed to be $3,500 per month, you're going to increase that to an even 4,000, maybe 4,500. Maybe you're crazy here. We're going to go up to 5,000. Again, keep in mind opportunity cost, but that is another way to keep the liquidity on your side, but slowly chip away at that. And that's an easy mortgage calculator, right? You can run, well, what if I pay an extra 500, knocks off X amount of years, an extra 1,000 knocks off X amount of years. So you can run those different ways, different numbers to see how you can pay that off sooner. This is one that we talk quite a bit with clients. We just kind of call it our meet in the middle. So we think 20% is our baseline. They have enough for 40. Kind of talk through some of these things, not completely sold on the 40, but they also don't want to be as low as 20. Meet in the middle. Let's do 30, right? Think of something of that nature. But my all-time favorite strategy, and this one we even will sometimes use in terms of arbitrage between like a 15-year and a 30-year, but 20% down and then invest the rest. And here's why that's attractive. So let's go back to that example I used earlier. And I just used it because it was good even numbers. But you have a 20% down payment already in the bank, but you have an extra 100,000. You can either put it towards the mortgage or you can invest it. The cool thing about investing it would be you're going to let that do its thing. Hopefully it does follow what we noted before. It outpaces the mortgage. We won't give it an actual rate of return, but it outpaced the mortgage. Well, now all of a sudden, 5, 10, 15 years down the line, you have this lump sum of money. It was liquid. It was there at all times. You might now be at that point. You're like, to heck with it. I want to get rid of this mortgage, take that extra money, plop it on the mortgage, paid off. That's why I really like that strategy. Also, one of my favorite strategies for the 15-year versus the 30-year, right? Lock in the 30-year mortgage, but you can also then say, well, I was going to do 15. Take the difference. Let's just say one was 2,500, one was 3,500. So the 15 years is clearly going to be a higher payment, right? So let's just say it was 3,500 compared to your 2,500. Well, take that $1,000 per month difference, invest that into the market. In a perfect world, if this all goes according to plan, again, you really want to crunch these numbers more precisely than what I'm just throwing out here. But you invest that $1,000 per month, and then you let that do its thing over 15 years. In a perfect world, in 15 years, you would actually have a decision to make. You would have enough money in there to either pay off your mortgage, or if you like how things are going, you can keep that money on your side. So a little bit of arbitrage per se in there where you're keeping control. That's the main thing here. We want you to have control, not the bank, aka your mortgage provider. So a fun topic, a topic that comes up quite a bit, again, in the physician world, because of that physician mortgage, I think we actually talk about this even a little bit more because we do have one extra tool in the tool bag per se. But for a lot of you, and again, questions we see through the YouTube channel, podcast, popular topic. And with rates really not giving in, and I know we all have those friends that, well, I locked in 2.5%, and now we're seeing 6-7%. Which, again, historically not too high, but it feels astronomical compared to what we just saw a few years ago. So I get it. So hopefully this adds a little bit of context on that 20%, maybe a little bit more, but also giving you some extra ideas. As always, thanks for hanging out with me for about 15 minutes or so as we try to keep our videos around that time frame. Sometimes we get it going, go a little bit longer. If you have not subscribed to the channel, please do so. Give us a thumbs up, help spread the word there. Questions, comments, concerns, drop those in the notes. As you know, I love to get back to you on those. Also love to get ideas there. So if you have any ideas, any other videos you want to see, send them our way. Again, thanks for hanging out with me. And as always, I will catch you on the next video.